Welcome to NREI's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at NREIonline.com. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. We're going to dive into this week's top stories. Good morning, David. How are you?
I'm doing well. How are you?
Fantastic. I'm excited. I know we've got a lot to cover today, so I'm going to let you go at it. What are we talking about?
So we're talking about three stories that we posted this week. One is a look at the top cities for Generation Z, which is based on some a ranking that this company Nestpick put out. Secondly, we have an update on what foreign investors are doing when it comes to U.S. commercial real estate. And then lastly, we have a piece at looking at what some of the implications are of the new rent control law that's gone into effect in California and what that might mean for multifamily owners and investors in that state going forward.
Gotcha. All right. So we've got quite a bit to cover. So we're starting with the world's top cities for Generation Z. And David, forgive my ignorance. Which generation is this now? What age group are we talking about?
This is like the people after millennials, basically. So Generation Z, I think roughly anyone that was born starting in the mid to late 1990s to the early 2000s is generally considered Generation Z.
Generation Z. All right. So they used a bunch of metrics. I've actually taken a look at those. Really, really interesting stuff. But I'm going to let you start. What are your observations?
Yeah, so I thought it was interesting. It did strike me just how comprehensive they were. Just to say who this is, Nestpick is they are a company that does listings for like furnished apartments. So it's just kind of like an online listing service, and I think that this is just a piece of content that they developed. I was struck that they went to such lengths to rate. They had kind of 5 big buckets of metrics. Those included digital, what they called principals, leisure, and business. And then among those, so that's 4, not 5. But then among those, then they had like 5, varying numbers of subcategories. So overall, they had 22 metrics by which they used to generate this ranking. I found the methodology pretty interesting and comprehensive. Then for the actual, the list that we posted was just the top 20. If you go to their site, you can view over 100 cities that they ranked across the board. But in terms of the top 20, I was struck by, it's very Eurocentric. So there's even in the top 20, there were 3, if I'm not mistaken, 3 cities from Sweden and at least 3 from Germany. So, and then a few others from other parts of Europe. And then the number 1 city that they came up with in their ranking was London.
Mm-hmm. Yeah, I noticed that the top cities that I was looking at, they were all very expensive cities, including Los Angeles, New York, London. Really, really expensive places to live. And I don't know. Overall, I know that there's a ton of metrics in there, but that seems pretty high-priced areas to live for any generation, not just Generation Z, who are still starting out, in my opinion.
Yeah, so, these are all, I think you're right, these are all fairly expensive cities if you're going to look at that housing, but I think that's balanced out by all these other metrics that they were looking at, which include things like connectivity and the availability of co-working space and the ability to freedom of expression, LGBTQ equality, things like that, which then these these cities score very highly in, which I think they're basing on things that they view as important for people who are members of this generation.
Yeah, and they did use a 0 to 100 or 1 to 100 scale. Right. And I found this very interesting, David. So 1 being the worst, 100 being the absolute best. For the most expensive city, we have Zurich. But under one of the other categories, which ranked as a 1, the lowest possible ranking. So being the most expensive. And then they also have a category, which I thought was very interesting, the right to protest.
Right.
And Zurich's a 100. So even though it's the most expensive, you can complain all day long.
Right.
Because it's 100. You're allowed to do that. And it'll come as no surprise to anybody listening. But if you filter this by the place that is least, you have the least right to protest, big surprise, Shanghai and Beijing.
Yeah.
We know that Hong Kong has been in the news a lot lately with a lot of protesting, a lot of human rights issues, and so on and so forth. But ranking it number or the number one, which is the worst, is both Shanghai and Beijing. So really interesting stuff. I love this.
Yeah. Actually, that is interesting. I didn't actually sort by that category, but looking at it now, I mean, it is a pretty interesting list of who's at the bottom here. Turkey, who obviously is in the news right now for some pretty awful things. UAE, our good friends Russia are down near the bottom here, and then several other Middle Eastern and then Pacific, and then Pacific nations like Thailand and Singapore. So I mean, not exactly surprising, but fun to look at. Not scoring well here.
Not doing so hot. And of course, the number one city for price wise was New Delhi, which they scored 100. So I'm assuming it's extremely cheap to live there. But I don't know how they ranked on the rest of it, because I see a few ones. In fact, a lot of ones in a lot of the different categories. Healthcare, I think, is one of them. Yeah, access to healthcare is a 1. So you can live there for super, super cheap, but don't get sick or hurt.
Yeah.
All right.
Yeah. I mean, and then so in the gallery that we did, that was one of the metrics. We couldn't, just because the way we formatted it, we couldn't put the scores for all these various subcategories for each city into the gallery we made, but we did include all of the ones that fit under business. So that did include the affordability metrics for those top 20 cities.
Gotcha.
And also included an entrepreneurial spirit and innovation, availability of co-working spaces, social entrepreneurship, and just an AI industry as well. Which that one jumped out at me as like, oh, okay, we are, like that's of importance now. We have to worry about what's happening with AI, and as a good thing. Apparently for some of these cities on this metric, because like San Francisco was the number one for AI industry. They got the 100 in that one.
Wow. Who got the number one? As in like just one? Like you're off the grid. I'm assuming you're off the grid in that city.
There was a number tied for one, and it's sort of interesting. Florence and Padua, Italy.
Huh.
Bruges, I'm probably butchering that. Bruges, Belgium, Quebec City, Doha, and Muscat, Oman all got 1s. So I don't know. I'm sort of. I guess it's interesting to, they definitely had a methodology. I don't, like for all these different things. You go on the site, it's pretty fascinating to see. But like what and the fact that you can kind of sort by each of the cities, by each of the categories, all that kind of stuff makes it kind of a fun sort of list to play with, So we just, for our piece, we link back to the full to this full site, but we did kind of like a takeaway version, top 20s. Included the business metrics, quick way to kind of digest if you're just really curious about seeing which cities that according to this methodology are the best for Gen Z. If you want to go dive deeper, you can follow the link from our site back to these guys.
Well, to wrap it up, I just want to say congratulations to Los Angeles and New York, who both made the top 5. And so that's 2 representatives from the USA in the top 5, and no other country in the top 5 has 2 besides us.
Okay, so there you go.
There we go.
and then I think San Francisco and Seattle also made the list.
Oh,
so
nice.
Two
in the top 20.
In the top 20.
Oh,
but,
right.
So for 4 of the top 20, 2 of the top 5. So yeah,
not
representing.
So bad. Yep, rep. All right. Anything else we need to cover on this one?
No, I think we got the highlights out of this one.
I believe so. All right.
So the next is looking at some of the latest numbers that we now have. I think this is actually something we've looked at a few times in previous episodes, but more metrics have come out about foreign investment in U.S. commercial real estate. And I think it's an interesting thing to come back to because it sort of speaks to I think it's interesting to always the reason I think it's important to look at this number is that most investors in U.S. commercial real estate are U.S. investors. They are also not investors that are going to invest in overseas. So they're just in U.S. commercial real estate for good and for bad. They're not like discretionarily. They may buy or sell at a slower or faster pace, but they're always buying and selling in the U.S. So it's more interesting in some ways to look at investors that are more discretionary if you want to get some kind of reading as to how attractive U.S. commercial real estate is, or flat out how attractive investing in the U.S. is. So I just thought that was important context for like why why this is why I find this a good number to look at. So what the latest numbers show, this is from Real Capital Analytics, is that cross-border investment declined 54% year over year in the most recent time period that they looked at. So, what does that mean? I think that means that partly what they explained it as on some of the people that we talked to is just general choppiness in the market. Some of this stuff there's just going to be fluctuation up and down. Maybe don't read too much into it. However, there are other factors that could be more important that aside from just general randomness. One is that it's just a sign of how competitive pricing has gotten, how tight yields are, in which case, it's harder to pull a trigger on a deal in the U.S. if you can get a better yield somewhere else. So that's one potential, and the search for yield has definitely been something that has driven patterns with how these investors operate anyway, because what we've seen is even when they've stayed in the U.S., they've gone from core markets to secondary markets. They've gone from core property types to some of the alternative commercial real estate property types, all in the search for yield. So, they've already had to be more creative to hit their targets. Now they seem to have backed off a little bit in terms of buying in the U.S. So it means that they're either seeing better yields elsewhere, that as a potential explanation. Yeah. But then the other factor that could be at play here is just, people seeing the U.S., seeing some of the potential uncertainty economically or politically in the U.S., and maybe like being a little more cautious about investing here right now.
Mm-hmm. I mean, that makes perfect sense, and it's definitely turbulent. So,
yeah. So I think that's why it's just, those are the latest numbers. Those are the potential explanations for what's going on. The only other sort of interesting point, I think, in the piece was the 5 countries that have been the most active buyers in the U.S. in the first half of this year were Canada, Israel, Germany, the UAE, and Bahrain. So those are the players at least the nations where the most active investors in U.S. commercial real estate have come from so far in the first half of 2019.
Gotcha. Any explanation why? Any thoughts on that?
I mean, Canada's always a big, obviously right next door, a lot of big pension funds, a lot of big REITs up there. So there's always a healthy amount of Canadian equity that's looking to get in U.S. markets. For some of the other, also Israel is usually a fairly consistent buyer, investor. There are some REITs that that are based there that invest in the U.S., or some REITs that have U.S. REITs that have a lot of money from Israel behind them. So, that's fairly consistent to see that. Some of the others, Middle Eastern money, that tends to find its way into U.S. real estate. So there's no real surprises and no real changes. Those are all maybe some of the specific nations might change, but seeing Middle Eastern money in the U.S., seeing Canadian money in the U.S. is nothing that unusual. So for some of these nations too, you often have sovereign wealth funds that are big investors in U.S. real estate, which I think could be the case with both UAE and Bahrain, in addition to any private money they have.
Yeah, and I'll be the first to say it. We love Canadians and their money. Either way. We appreciate you, Canada.
The last factor that's at play when anybody's doing this kind of stuff is currency hedges. So, which is a little bit beyond my, outside my
me too
wheelhouse, but I know that plays in. When you're looking at your currency, domestic currency, or comparing different currencies, that can play into where you decide to invest as a way of mitigating risk.
Mm-hmm.
So that's kind of what we need to get out of that piece.
All right. Moving on to California's new rent control law. So what are we talking about here? This sounds like a pretty big deal.
Yes. So California, the law was put into law. It goes into effect January 1. So going forward, what this will mean is that multifamily landlords will have a maximum amount that they can raise rents in a given year, and it's actually set at a fairly high number, in my opinion, which is that it's 5% plus the rate of inflation. So that would allow a maximum annual rent increase of 8%. I think for the most part, if you're, so the only real kinds of the properties that would be most affected by that kind of thing, that where it might actually slow down some investment in the space, is if you're trying to buy a more rundown property or a mismanaged property, and you're trying to come in. You want to renovate the thing and you want to bring it up to market rents, then you'll have some problems, because in that case, the trying to take, if you're taking a lower class property, turning it into a higher class property, but not being able to raise the rents to what the higher class rents should be, that's a problem. For most other situations where you're talking about just like annual rent increases on existing tenants, or if like you're not talking about a property that's had any major equity put into it, I think in most years you're not going to see, rent increases anywhere close to 8%.
So, but this is truly, though, it really only affects those folks that are going to buy property that have current tenants in it, that they're going to be renovating and while the people are in there, because if there's nobody in there, I would assume that you refurb it, you do whatever, make it a higher end property, then you don't have to abide by that law, correct? Because there's nobody in there to raise rent on. It's just you set a higher rent.
Yep. Yeah, so that's correct. So basically, it's meant to protect the situations where not necessarily buying. Yeah, if you buy a vacant building and you renovate it, you're going to charge market rents. I think what it's meant to, the situations that I'm talking about would be, where somebody tries to come in, buy a lower class building, and then jack the rents up on the people who are there, and basically and let's be honest, in an effort to replace them, since
exactly.
they will, no one's going to be able to, you raise the rent on somebody that's by 20-25% or something like that. That's just not tenable.
Yeah, that's to me, it's criminal, right? I mean, you're basically making somebody homeless at that point, or they have to change their entire life because you want to get higher, quote unquote, higher end tenants in there, or just make more money. So, no, I agree. It's a good thing to have some regulation there.
Yeah. So, I think, the industry in general doesn't like rent control, obviously, because anything around any implication about caps on being able to raise rent, which then could affect your ability to generate incomes, all that sort of stuff, is there's going to be resistance to it. But to me, it seems like the window here, the window of rental, what they're allowed to do, is not really going to affect that many people. It's not going to really slow. It's not going to really. It's not a disincentive to a whole lot of people. People are still going to be able to raise rent at up to 8% a year. And I don't think that's going to have a dramatic effect on how people are investing in multifamily property in California. And that's generally what some of the what the people we talked to for the article said too, which is that it's not going to have a huge effect on the majority of assets. There's probably I'm sure you will be able to find examples of somebody who wanted to do X and then couldn't, and that deal doesn't happen. But for the most part, this doesn't seem like it's like something that would be massively disruptive to the industry. I think a lot, but a lot of people aren't going to want to take that line because they don't want, the industry doesn't want there to be this kind of regulation because they want to be able to do what they want to do.
No, that makes absolutely perfect sense. And here's the good news, David, is that if they're in Los Angeles scored 85 on the right to protest thing. So if they really want to protest this issue, Los Angeles got an 85 on that list from earlier.
There you go.
Hey,
yes.
Get out there with your picket sign and go to it.
Yeah. Good point.
All right. Now that wraps up our California stuff. What other headlines did you guys cover this week?
Yeah, a couple other pieces to just draw attention to. One is we had some numbers from CoStar looking at what retail construction levels are within the industry overall across all the retail subsectors. Spoiler, development remains low and for retail, but you can go kind of look at the more in-depth numbers in the story. Secondly, there was a conference in New York this week on commercial real estate technology. So we had some pieces looking just at what's going on with prop tech. One is just we have a couple of pieces that are just takeaways from what was discussed at the conference. We also did a kind of a little mini roundtable with a few different experts from Deloitte and Chamber Creek and this company called Stratus, which is a smart apartment IoT platform. So we just, talked to them about how commercial real estate players can make decisions about what technology they should be investing in, just given the wealth of options on the market. And then last week we had another Q&A with the CIO of Kairos Investment Management about just how people should approach investing in REITs right now. So those were some of the other highlights for the week that people can check out at NREIonline.com.
Perfect. Thank you so much, David. This was great.
Thank you. Thanks for your time. Have a good weekend.
Absolutely. You too. And thank you all for listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, which he does weekly, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your colleagues. Thanks again for listening today. For everyone at NREI, this is Eric Johnson inviting you back next week for all the news that matters to you. We'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of NREI or Informa. The content has been made available for information and educational purposes only.